Welcome to Financial Launchpad, a podcast designed to teach you about personal finance by starting with the basics and progressing to more complicated topics. We'll tackle a new topic every week and provide additional resources to learn even more and action items to launch your personal finance journey. I'm your host, Emily, and thank you for joining me as I discuss the topic of compound interest and fees. So a quote by Einstein is often shared when talking about compound interest. He once called it the eighth wonder of the world. Compounding interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. So what exactly is compounding interest? Essentially, it is when you have a sum of money, you earn interest on it. And then the next year, you earn interest on that initial portion as well as interest on the interest that you earned. So it's one of those things that starts off very small, but then after a long period of time, you see that your initial starting point makes up a very small amount of what that final sum is because it's interest building on interest. And that happens, both in bank accounts when you're earning interest and then also within the stock market. It's not technically interest, it's more of a rate of return, but it's still a very similar principle. And one way to think about this, and an easy math and a rule of thumb, is the rule of 72. So what it says is that this tells you how often your money will double at a certain interest rate approximately. So say you're earning 8% interest. And if you take 72 divided by 8, that would be 9. So that means that while earning 8% interest, you can expect your money to double in 9 years. Similarly, if you're earning 7%, let's say, 72 divided by 7 is approximately 10. So if you're earning 7%, your money will double in approximately 10 years. And I think that just shows how mind-boggling compound interest really is, because you seem to be dealing with small numbers, 8, 9, 10% or whatever, but your money would double on its own in a relatively short amount of time. So that's just a rule of thumb to kind of figure out, like I said, how often your money would double. And this is somewhat related to one of the articles that I have linked that talks about the rates that you will accumulate money basically every $100,000. So that first $100,000 that you manage to save and invest takes a long time. Each $100,000 milestone you reach after that takes less time to accumulate. The article assumes the same steady contributions, but the compounding rate of return really starts to work for you, and it takes less time to get each subsequent $100,000 milestone. That is a really interesting article that I wanted to share, because it kind of talks about why that first 100,000 can just be really, really tough, and then it starts to get a little bit more downhill after that. So when you're doing your calculations and kind of looking at your portfolio and all of that, general rules of thumb of rates of return include 12% on the high side. That is the number that Dave Ramsey likes to throw out all the time, which isn't necessarily inaccurate, but a lot of people think that it's definitely not as conservative as you may want to be. A more common one that's used is like 6, 7, 8% rate of return when you're calculating those sorts of things. And what I want to point out is that these rates of return really depend on that asset allocation. You're not going to get these rates of return if you're invested in 100% bonds. It's a lot more similar to being fairly aggressively invested. So a lot heavier on the stocks and maybe, 10% in bonds or so. So what you're using in your calculations, that rate of return really depends on your asset allocation. And if you are young and you are investing aggressively, that's where, the 7 or 8% rate of return is a fairly common number that's used when doing calculations. And I think that it's important to really get into these calculators and play around with them, because it's hard, at least for me, to visualize and understand the effects that these interest rates have. So I have a couple of examples here. So all of these examples, the criteria is that your current age is 27, and then the age you plan to retire is 67. So we're looking at a 40-year horizon. You have nothing saved for retirement right now, and you will be contributing $500 monthly. That is the scenario for all of these. And just looking at how much money you'll have at the end of those 40 years while investing $500 per month based on those different interest rates is really incredible. So if we're assuming an 8% interest rate, at the end of those 40 years, you'd have about just under 1.7 million, which is a lot of money. If you knock that down to 7%, so it's just 1% difference, which doesn't seem like a whole lot, but it really is. You go from 1.67 to just under 1.3. So that's, $400,000 difference. And then continuing on to a 6% return, it's under $1 million. So the difference between that 8% and that 6% is about $700,000. So that is really, once again, the magic of compounding interest. And, when you're not getting that rate of return and stuff, then you don't have all of that money and all of that interest compounding on each other and working to your benefit. So I really encourage you to get into the calculator that I have listed and just play around with them, see what different contributions do, see what different time horizons do. You can do less than 40 years and see how drastic of a difference it is between 30 years and 40 years and how much those last 10 years really affect your portfolio. And with these numbers, I've tried to research it a little bit. It's a little bit fuzzy sometimes on whether or not inflation is taken into account for this. I think that on the 6% side, it's potentially, more conservative and okay to assume that maybe inflation's included in that. I generally like to assume, possibly without it being adjusted for inflation, interest rates of 9 or 10% might be likely, once again, depending on that asset allocation. But inflation is often assumed to be between 2 and 3%. And that's one of those assumptions that I always look at on the online calculators if it is adjusting for inflation and really what numbers it's giving me. Because with this compounding interest and the inflation, you have to be looking at essentially kind of the present value of money. $1 million today is going to be worth more than $1 million in the future. And essentially there are ways to adjust that. And if you've taken an economics class, you should be familiar with that, with, the future value and the present value and all of that fun stuff. But you really want to be looking at essentially apples to apples and knowing whether or not you're calculating things with inflation. And here's an example. Say we have that $500 a month that we're investing, and we want to assume an 8% rate of return, which doesn't account for inflation. So if we want to account for inflation, let's just say that it's 2%. That's generally what the federal government is aiming for. You can run those numbers and get that 8% number, and that's the $1.67 million value that I talked about before. But if we wanted to look at it in present day dollars more so, that's when we would actually put in that 6% number and understand that it's actually just shy of $1 million. So that difference, that $700,000 difference, is essentially accounting for inflation and making sure that you understand that, 40 years down the road and an 8% rate of return, that 1.7 million isn't in today's dollars necessarily. The $1 million is a little bit more in today's dollars. So that's one of the things that trips me up a little bit, is just figuring out, are we talking about today's dollars or are we talking about dollars down the road that haven't been adjusted for inflation? Because when you're actually calculating how much money you're going to need and how much money you'll have, you really need to start accounting for inflation, because obviously 40 years down the road it can make a very large difference. All right, so with all of this talk about compound interest, what Einstein talked about is that he who understands it earns it, he who doesn't pays it. So all of these interest rates, this applies to your debt. It's one of those things where, either you're earning this interest or you're earning the rate of return, or you're paying it. So you can really see how it can start to balloon out. And that's why, if you have debt payments, those interest payments can really affect quite a bit, especially in the beginnings of a mortgage when you're paying more in interest than you are to the principal. And that's really disheartening. Another instance that this compounding interest does not work to your benefit are fees. And basically, when you have in your portfolio, there are a variety of fees, and sometimes they can be really sneaky about them. And there are fees associated with the funds that you choose themselves. These are called expense ratios, generally, which is just basically how much they charge to have the fund available. If it's an actively managed fund, which means that there are specifically managers kind of tinkering around with it and trying to essentially beat the market, the fees are going to be higher because there's somebody behind the scenes constantly messing with it. And then there are passively managed funds that they're essentially trying to match a benchmark, and say this S&P 500, the S&P 500 index fund is just trying to match the S&P 500. So there isn't really a lot of playing around with that, and therefore the expense ratios are a lot smaller. Examples would be a 1% expense ratio for an actively managed fund versus a 0.04% expense ratio. And what we just talked about with fees, that's a difference of nearly 1%. So you can start to imagine how much those fees can affect your returns. Other fees on funds, some of them charge a front load or a back end load, sometimes up to about 5.5% or so. And Sam and I actually used to be in loaded funds, and we did not understand what they were at the time. And it was a 5% load, which meant that if we contributed $100, they automatically took 5% off the top and invested $95. So I ran a different example of that. Just to recap, we're looking at a 40-year horizon, $500 a month, and I'm using that 8% annual return. So similar circumstances, you're still contributing that $500, but it's to a loaded fund that takes 5% off the top. So it's actually only investing $475, and still that 8% return. We're keeping that constant. The difference is $1.67 million for that $500 that's wholly being invested versus $1.6 million. So essentially it's a difference of about $70,000 at the end, which is crazy because the difference in contributions is $240,000 versus $228,000. So the difference is only $12,000 of what you put in, and the ending results are $70,000. So that's kind of the effect of loads and how you would calculate that. Those are the fees specifically that are associated with the funds themselves. You know, that expense ratio, that all of them have an expense ratio, but you really want to try to avoid those load funds. On top of this, you may have advisor fees where, you know, not even associated with any of your funds, you're just paying your advisor to advise you. And that could be anywhere between like 1% to 2% on the high side. And that's just applied to your entire portfolio. That's on top of your expense ratios. That's on top of any loads that you're paying. That's on top of any fund fees that you're paying, any other management fees. So that can really eat in to your profits, essentially. And once again, looking at 8% versus 6%, ignoring inflation, let's just say that they would both be returning 8%, but one of them has no fees. You'd be actually seeing that 8% at the end, versus another fund that is also returning 8%, except then you have to subtract off the 2% fee cumulatively. And that's once again the difference of $700,000. So that 2% difference over 40 years, it multiplies is so quickly towards the end. And it's one of those things you may not see at the beginning, but it really balloons out to the point that you're losing, 40 to 50% of what you should have been making because you're paying those high fees. And that's where Sam and I found ourselves in last year when I started to calculate our funds and the expense ratios and our advisor fee and all of that. We weren't in any loaded funds at the time, but that's when I realized that we were paying 1.8% in fees. And that was part of my own ignorance. I didn't know that would have such a big effect. I mean, it's not one of those things that intuitively you think that 1% to 2% is all that much, especially when you don't have a whole lot there. 1% on $10,000, you go, $100 a year, that seems reasonable. That seems fine. But realizing how much that compounds and what you lose over time is just really astonishing. So that's kind of an introduction to the effects of fees and why we've adopted essentially investing strategies that really focus on the fees. And we'll get into that more, talking specifically about actively managed and passively managed funds. That's where it really comes into play. And right now we're mostly invested in passively managed funds just based on some of this research and stuff. And like I said, we will get into that more later because there are pros and cons and people that like one or the other for different reasons. I also talked about management fees. This is one of those sneaky ones that often occur in your employer portfolios. And this is where you really need to read the fine print and figuring out what you're invested in. Now, with employer funds, it's not like I would necessarily advise you to stop contributing to them just because the fees are high, but just merely knowing that that exists and maybe making different decisions on as you're funding different funds. Say you have a 401k and you have a Roth IRA. As you're trying to figure out where to direct money, being aware of the fees that are associated with each of those investment vehicles, essentially, I think can help tell you where to be putting your money, basically where you have control and where you can control those fees. So yeah, the places that you find fees are within the funds themselves, and that will be listed in the prospectus that you can read over and learn more about the fund. And then also any paperwork related to the investment vehicles that you're in and the companies that you're invested with, the specific management companies such as Vanguard or whoever has your 401k or 403b, things like that. That's where those fees hide. Just wrapping up a little bit to really get a handle on the effects of compound interest, because it's mind-blowing, honestly. I remember being in engineering econ and doing a bit of this, and my mind was blown. I think it's still one of my favorite things that I learned in college. And does it have a whole lot to do with my job? No, not really. But the math of it is pretty incredible. And really just playing with these charts, playing with the time horizons, playing with those percentages, playing with how much you put in can really be eye-opening. And a real-life example of how this is used is if you've heard of endowed scholarships, which essentially you put in a big chunk of money and you're able to withdraw a smaller portion of that forever. You know, they set it up so that hopefully you never actually touch that principal. And what we're trying to do right now with the organization that I'm involved in is start an endowed scholarship so we can basically withdraw $1,000 per year forever. And you need to start with a nest egg of $25,000. So that means that you can pull off 4% of it each year and never lose the principal. And that is really based on, once again, that asset allocation, making sure that it is at least gaining 4% per year. Or if it doesn't gain that, it doesn't, lose too much, or, there's a few different things going on with it. But the idea that you can maintain this principal year after year and be able to draw $1,000 off of it is awesome. And that's how endowed scholarships work. That's how a lot of scholarships work. And that's just a real life example of it. And essentially for retirement, if you're trying not to touch the principal, it's a similar situation. So it's related to all of that. All right, so your action items. Like I said, go play around with a compound interest calculator. I also linked to a financial calculator that you can download as an app on your phone, and there are so many different options to just play around with and be able to calculate things on the fly. Your second action item is if you are investing, especially with your company, or if you've opened up a Roth IRA or something else, go research what your expense ratios are, and if they have any loads, and if you have an advisor, what are your advisor fees, and any other fees for your investments. Go tally them up and figure out what your fees are. We'll get into if you should consider changing any of that, but now that you can see the effects of fees, I think it's a good time to just go and see what you're actually paying. And I will also link to Morningstar.com, which is a great place to, if you have the 5-letter ticker symbol for your fund, you can plop it into Morningstar and it'll tell you the fees, and even giving some guidance on if that's high or low or whatever. But Morningstar is a great spot to go and research funds. So that's what we're getting into a little bit now, is starting to research those funds. All right, I think that's all that I have to say about compounding interest. But if you want to talk with me and gush about the magic of it, that'd be fine with me. Thanks, everyone.